Chapter 10, Stockholders' Equity. Understand unique features and recording of preferred stock. In order to attract wider investment, some corporations issue preferred stock in addition to common stock. Preferred stock is preferred over common stock in two ways. The first, preferred stockholders usually have first rights to a specified amount of dividends. It's normally a stated dollar amount per share or percentage of par value per share. If the board of directors declares dividends, preferred shareholders will receive designated dividends before common shareholders receive anything. Preferred shareholders also have preference over common shareholders in the distribution of assets in the event the corporation is dissolved. Preferred stock can have some flexibility to it. It can be convertible, meaning it allows the stockholder to exchange shares of preferred stock for common stock at a specified conversion ratio. Sometimes preferred stock is redeemable at the option of either stockholders or the corporation. A redemption privilege might allow preferred stockholders the option, under specified conditions, to return their shares for a predetermined redemption price. Lastly, the most important part that we're going to discuss in this chapter is cumulative. Preferred stock is usually cumulative. If specified dividends are not declared in a given year, they become what's called dividends in arrears, and they accumulate until the company does declare dividends. So if a company doesn't declare and pay any dividends, the company has to pay those dividends to the preferred shareholders for every year they have not been paid, including the current year, before common shareholders receive anything. So these are some comparisons of financing alternatives, and I'm not going to talk too much about bonds because we skipped chapter 9. The biggest thing in this to understand is that preferred stockholders do not have voting rights. In order to get those preferences in dividends and preferences in the distribution of assets, they're giving up their right for voting. They're giving up their right to elect the board of directors. So that's a big difference between common stock and preferred stock. You can see the risk and the expected return compared, preference for dividends, interest, and assets, and the tax deductibility of payments. But the biggest thing I want you to understand is this lack of voting rights for preferred stock. So how do we account for preferred stock? Well, when preferred stock is issued, the journal entry is the same as it is for common stock, except we're going to use the new account called preferred stock. So let's assume Canadian Falcon issues 1,000 shares of $30 par value preferred stock at $40 per share. Notice the higher par value in the preferred stock. You're going to see this a lot of times, that the par value of preferred stock is higher than the par value of common stock. So they issued 1,000 shares at $40 per share. They received $40,000 in cash. Next, we need to record our preferred stock account entry. So 1,000 shares at par value is $30,000. Notice this is going to preferred stock. We have two different accounts. We have common stock and we have preferred stock. We have to keep those separate. So what's going to be our balancing credit? The difference between the market price and the par value of $10 per share times 1,000 shares. Right. Additional paid in capital. Same thing we did for common stock. Record the difference when issued above par value to the additional paid in capital account. So here is Canadian Falcon's stockholders' equity section of the balance sheet thus far. You see that preferred stock is listed first, and we list the par value, the number of shares authorized, and how many are issued and outstanding. So the preferred stock is showing just the $30,000, the 1,000 shares times the $30 par value. Then common stock is next, has 1 cent par value, 1,000,000 shares authorized, 1,000 shares issued and outstanding. So our balance in our common stock is $10. The 1,000 shares times the penny par value. Additional paid in capital is $39,990. That is the additional amounts for both the issuance of the common stock and the preferred stock. So we have total paid in capital equaling $70,000. Then it just goes ahead and tells you that it has previous retained earnings of $30,000. So at this point in time, stockholders' equity has a balance of $100,000. Now, we need to discuss the difference between cumulative and non-cumulative dividends. So in this example, look at just this top part right here. If preferred stock is cumulative, we're going to say that in 2019 and 2020, there was no dividends declared and paid. Then in 2021, there were dividends that were declared. So we need to go back and pay dividends in arrears for the 2 years that we haven't paid preferred stockholders plus the current year. And the calculation for how to figure preferred dividends is the number of shares outstanding times, in this example, it's 8%, times the par value. So we're going to pay them $2,400 a year for 3 years. We're paying the 2019 dividends in arrears that have not been paid, the 2020 dividends in arrears that have not been paid, and the 2021 dividends for the current year. So if we had declared a $10,000 total dividend, preferred shareholders are getting all of this money before anything is distributed to common shareholders. So you see why cumulative dividends are good for preferred shareholders. They're entitled to an amount every year, whether a dividend is declared or not. When a dividend is finally declared, they have to catch up and pay everything that has been accumulating since the last dividend. If preferred stock is non-cumulative, we don't care about the 2 years it wasn't paid. If it's non-cumulative, we're not paying dividends in arrears. We're only going to pay for the current year, $2,400. So of the $10,000 dividends that we're paying out, a much larger portion is going to common stockholders. So make sure when you're working the problems, you're reading, are the preferred stock dividends cumulative or non-cumulative, and understand the difference between those two transactions.